Your last paycheck had a number on it. That number is a lie. Not because your boss is cheating you, because of everything that was taken before the money ever reached you. And here's the question nobody thinks to ask. If taxes are just how the system works, why does a janitor pay a higher tax rate than a billionaire? That's not an exaggeration. That's a measured fact. And by the end of this video, you'll know exactly how it happens and the strategy behind it. It has a name, 3 words, completely legal: buy, borrow, die. But first, we need to talk about how much you actually pay, because almost nobody knows their own number. If you earn a salary in America, you work January, February, March, and half of April for the government, 3.5 months, every year, before a single dollar is truly yours. And the way it's collected is designed to be painless. The money vanishes before it hits your account. You never feel it leave because you never held it. Economists have a name for that design: withholding. It was invented in 1943 to fund a world war, and it worked so well at hiding the pain that it never went away. Put real numbers on it. $80,000 a year, a good salary. Federal income tax takes its slice. Payroll tax, Social Security, and Medicare takes 7.65% right off the top. Add a typical state tax. You keep about $60,000, $20,000 gone. Every year. That's a decent used car vanishing annually forever. And that's before sales tax, before property tax, before a single gallon of gas. Now hold that thought, because in 2021 something remarkable happened. Somebody leaked the actual tax files of the 25 richest Americans to a newsroom called ProPublica. For the first time in history, we got to see what billionaires really pay. Ready? 3.4%. That was their true rate. Their tax paid, measured against how much their wealth actually grew. You pay 30–40% on money you sweat for. They paid 3.4. And here's the part that should keep you up at night. Almost none of it was illegal. So how? The answer starts with a distinction most people never learn. The tax code doesn't really tax people. It taxes events. A paycheck is an event. A sale is an event. But wealth quietly growing in value, no event, no tax. Remember that, because it's the key to everything that follows. Let me show you what the system does to $1 of salary, the whole journey. You earn it. Withholding takes its cut, and your dollar is 70 cents before you touch it. You spend it. Sales tax at the register. You drive. Fuel taxes baked into every gallon. You buy a home. Property tax. Every single year. Forever. On money that was already taxed. And when you die, if you did really well, the estate tax is waiting at the door. Count the journey. The same dollar taxed 3, 4, 5 separate times. Over a lifetime, 70 or 80 cents of it goes to the government. Nobody ever shows you the whole journey on one screen. You just watched it. Now the sentence that explains everything. The tax code was built to tax labor, people who trade hours for money. At that job, it is ruthlessly efficient. What it was never really built to do is tax ownership. And once you see that line, you can't unsee it. Every rich person you've ever heard of lives on the other side of it. Which brings us back to those 3 words. In the 1990s, a tax professor at the University of Southern California named Edward McCaffrey was trying to explain to his students how America's wealthy actually live. He boiled it down to a formula so simple it sounds like a joke. Buy, borrow, die. It isn't a joke, it's a system. Here's step 1. Buy. You take money, usually the bank's money, and buy things that grow. Buildings, businesses, stock. Now here's the trick hiding in plain sight. As those things rise in value, that growth is called an unrealized gain, and unrealized gains are not taxed. Your buildings can gain $1 million this year. Your tax bill on that, 0. Remember, no event, no tax. Holding is not an event. This sounds like it can't possibly be the whole trick. It isn't, because you still need money to live on, groceries, houses, yachts, and the moment you sell something to get cash, you've created an event and the tax man appears. So how do the rich get cash without ever selling? That's step 2, and it's the beautiful one. Borrow. They walk into a bank and borrow against what they own. And here is the single most useful sentence in this entire video. A loan is not income. Borrowed money is not taxed. Not at 37%, not at 3%, at 0. Watch it work. A building bought for $200,000 grows to $400,000. Refinance it, the bank hands you $150,000 in cash. No sale happened, no income happened, no tax. And the loop repeats. Buy the next building with it, let it grow, borrow again. Wealthy families have been spinning this wheel for generations while everyone else argues about tax brackets. When Elon Musk needed billions in cash, he borrowed against his Tesla shares because interest costs a few percent and selling costs 20 or more. Jeff Bezos ran Amazon for decades on a salary of about $80,000, a school teacher's pay, while his fortune grew past $100 billion sitting in stock. Untouchable, not hidden, untouchable, because holding is not an event. ProPublica ran the numbers on him. Between 2014 and 2018, his wealth grew by $99 billion. His true tax rate over those years, under 1%. Which leaves one problem. Loans come due, gains pile up. Sooner or later, the bill has to arrive, right? That's step 3. And step 3 is the one almost nobody outside the wealth industry has ever heard of. Die. In the American tax code, there's a rule called stepped-up basis. When you die, the official purchase price of everything you own resets to its value on the day of your death. Follow what that means. A lifetime of gains, millions of dollars of growth that was never sold and never taxed, is wiped off the books in a single moment. Your heirs inherit at the new price. The capital gains tax on your entire lifetime, not delayed, erased. The debts get paid from the estate, the assets pass on, and the wheel starts again, one generation richer. Buy, borrow, die. Buy things that grow. Borrow to live because loans aren't income. Die, and the gains evaporate. 3 steps, all legal, all documented, and all completely unavailable to anyone who lives on a paycheck, or so most people think. Because here's what the video you clicked doesn't usually tell you. Smaller versions of these doors exist for regular people. Congress built them. Most people walk straight past them every payday. Door 1. The 401k. Every dollar you put in skips federal income tax now, and if your employer matches, that match is the only guaranteed free money the system will ever offer you. A major study by Vanguard found that roughly 1 in 4 workers doesn't take the full match. That's leaving part of your salary on the table, every month, forever. If your employer matches 3% and you skip it, on an $80,000 salary that's $2,400 a year, a used car payment declined. Door 2. The Roth. Pay tax on the money once, today, then decades of growth, completely tax-free forever. It's the closest a salaried person gets to the billionaire's trick. Growth the IRS never touches, because inside a Roth, growth is not an event. Door 3, and tax professionals will tell you this quietly, like a secret, the HSA. The health savings account is the only account in the entire American tax code that's never taxed at all. Money goes in untaxed, grows untaxed, comes out untaxed for medical costs. Triple immunity. Most people who have one use it like a debit card and waste the superpower. Door 4. The 1-year line. Sell an investment you've held 11 months and the profit is taxed like salary. Hold it 1 year and 1 day and the rate drops to 15%, sometimes 0. On a $10,000 gain, that single calendar page is worth about $900. The most expensive impatience in America. And door 5, the big one. Ownership itself, a rental property, a side business, anything that moves part of your income from the wage side of the line to the owner side. Owners get depreciation. The IRS assumes a residential building wears out over exactly 27.5 years, so the owner deducts a slice of its whole value every year. A building that's full and profitable can show a paper loss. Owners get the 1031 exchange, sell a building, roll into a bigger one, postpone the tax, sometimes all the way to that stepped-up finish line where it vanishes. A landlord with one duplex is running Musk's playbook with smaller numbers. Same rules, same doors. So what do you actually do this week? 3 moves, smallest first. 1. Find your real number, pull up your last pay stub, and calculate what percentage of your gross pay actually reached your account. Most people have never once looked. 2. Capture every dollar of your employer match and nudge your contribution up 1%. You will not feel it, and future you collects decades of untaxed growth on it. 3. Before your next big money decision, ask the owner's question. Does this pay me once and get taxed like wages, or does it build something that grows quietly on the right side of the line? Let's end where we started, with the janitor and the billionaire. The difference between them was never effort. The janitor works harder. It was never intelligence. It's that one of them earns events, and the other one owns things. The system taxes events. It barely touches things. You can be angry about that. Some anger is fair, but anger doesn't compound. Understanding does. And to be clear, pay what you owe. Roads, schools, fire trucks, that's the deal. But there is no virtue in paying more than the law requires. The wealthiest people in America never do. Now you know why. And more importantly, you know where the doors are. Next video, the oldest money fight in America. Real estate against the stock market with the real numbers on both sides, because for most people, one of them quietly wins, and it's probably not the one you think. If this channel is starting to feel like the money education you never got, subscribe. We saved you a seat inside.